probably been hearing a lot of buzz around stablecoins lately. They seem to pop up everywhere: finance, tech, even political discussions. So for today's deep dive, we want to, cut through some of that noise, give you a clear picture of what they are, why they're taking off globally, and importantly, what this all means for finance, especially for the US dollar.
Absolutely. And this isn't just another tech fad. It feels more fundamental. It's really about how value moves. And that has pretty big implications for, well, national economic plans and the old school financial systems.
Okay, let's unpack that. So basically, a stablecoin is a type of cryptocurrency. It runs on a blockchain like Bitcoin or Ethereum. But the key difference, the defining thing, is stability.
Exactly. Unlike your typical volatile crypto, these are designed to hold a steady value. Most often, they achieve this by being pegged, usually one-to-one, to a stable asset. The US dollar is the big one here.
Right, and you have major players like Tether, that's USDT, and Circle with USDC. They dominate the market, and they back these coins with reserves.
Yeah, that's the idea. They hold reserves, typically in very liquid things like actual US dollars or very stable short-term government bonds. What's crucial is this mechanism. It lets you swap your stablecoins back for the fiat currency, like the dollar, anytime. That's what keeps the price pegged.
Okay, that makes sense. Now let's talk about the upsides. There seem to be some pretty compelling advantages. They're apparently really useful for sending money internationally.
Oh, definitely. Cross-border payments are a huge use case. Transactions can go from taking days down to, well, seconds sometimes, and the fees can be much lower because you're bypassing the traditional banking networks.
And privacy. Is that a factor too?
There's a degree of privacy, yes.
Yeah.
And think about countries dealing with, say, hyperinflation or really strict controls on foreign currency. In places like that, stablecoins have become this kind of essential digital dollar, a stable way to transact when the local currency isn't reliable.
Interesting. But it can't all be positive, right? What are the risks we should be aware of?
No, you're right. There are definitely risks. While the coins aim for stability, there are still concerns about how they're used. A lot of activity happens in the, let's say, highly speculative crypto markets where stablecoins act as a bridge. And there are persistent worries about links to illicit stuff like money laundering.
And what about the impact on the traditional financial system? You mentioned bypassing banks earlier.
Right. That's a big one from a systemic view. If stablecoins become widespread, they fundamentally go around traditional intermediaries like banks. That could mean banks lose access to, flexible deposit funds, which might impact their ability to lend. It could weaken that connection between banks and the wider economy. It's something regulators are watching closely.
That makes sense. So
Yeah.
despite these risks, you're saying adoption is actually speeding up.
It really is accelerating quite rapidly on a global scale. And this boom has kicked off a major regulatory push pretty much everywhere. We're seeing the US, Hong Kong, the EU, Singapore, the UK, South Korea. They're all introducing or drafting laws.
And big companies are jumping in too.
Oh, yeah. It's fascinating. You've got the established crypto players like Circle and Tether, but also payments companies like Stripe, big banks like JP Morgan, Goldman Sachs, even rumors about Amazon and Walmart exploring this space. Plus, many traditional financial institutions are expected to launch their own stablecoins, maybe by the end of 2025. It's like a can't beat 'em, join 'em situation.
A real global group fight, as you put it earlier, maybe. Governments, regulators, central banks, all getting involved.
Pretty much. Everyone wants to shape how this evolves.
So let's bring it back to the U.S. What's the strategy there, especially concerning the dollar?
Well, the U.S. seems to be taking a leading role in adoption and regulation. A key development was the Genius Act. President Trump signed that into law, framing it as a move to keep America dominant in global finance.
And what does that act actually do?
It specifically targets U.S. dollar-pegged stablecoins. It sets rules like requiring them to be fully backed by liquid assets, actual dollars, or U.S. Treasury bills, and it mandates monthly public reporting of reserves. More transparency, basically.
Okay, so the goal is regulation, transparency. But what's the bigger strategic play here for the dollar?
The underlying objective, it seems pretty clear, is to maintain and even strengthen the U.S. dollar's global dominance. Think about it. Roughly 99% of stablecoins today are pegged to the dollar.
Right.
So as these get used more widely around the world, it effectively extends the dollar's reach. It's like dollarizing parts of economies that don't primarily use the dollar.
Huh. I hadn't thought of it quite like that.
And there's another angle, demand for U.S. debt. About 60% of stablecoin reserves are held in short-term U.S. Treasury bonds. Tether, for instance, was a massive buyer of U.S. debt. In 2024, we're talking tens of billions of dollars.
Wow.
Yeah. Some projections even suggest that demand from stablecoin issuers could add over $1 trillion to the demand for short-term U.S. treasuries by 2028. So you see, it's not just about crypto tech. It's become intertwined with reinforcing existing financial power structures, particularly the dollar's central role.
Okay, so we've covered a lot. We've looked at what stablecoins are, the mechanics, the pros, the cons, the global race to regulate, and this U.S. strategy to sort of co-opt them to boost the dollar.
That sums it up pretty well. It's a complex picture with a lot of moving parts.
Definitely. So here's a final thought, maybe.
Go for it.
As stablecoins get more embedded in global finance, how might their spread reshape things beyond just finance? Like geopolitical relationships or maybe international trade patterns?
That's a really interesting question. The ripple effects could be quite significant, well beyond just the economic sphere.
Something to mull over, perhaps, until our next deep dive.